In this video, we'll discuss Sarbanes-Oxley and its impact on corporate governance and financial reporting. Sarbanes-Oxley is a big part of what accountants manage in their day-to-day work if they work for a publicly traded company. Many not-for-profit organizations also implement SOX because it demonstrates that the organization has implemented strict financial and organizational controls which may be important to raise funding. What is Sarbanes-Oxley? The Sarbanes-Oxley Act of 2002, aka Public Company Accounting Reform and Investor Protection Act, aka SOX, is a United States federal law that mandates certain practices in financial record keeping and reporting for corporations. The act is a combination of bills submitted by two senators, Oxley and Sarbanes, and the act was approved in the House by a vote of 423 in favor, 11 opposed or abstaining, and in the Senate with a vote of 99 in favor and 1 abstaining. President George W. Bush signed it into law, stating it included the most far-reaching reforms of American business practices since the time of Franklin Delano Roosevelt. The level of support for the Sarbanes-Oxley Act is a testament of the outrage people felt with regard to the corporate and accounting scandals, including Enron and WorldCom. The U.S. wasn't really the only country that had issues, though, and other countries quickly adopted similar laws. The Act contains 11 sections and requires compliance by all U.S. public company boards and directors and management, as well as public accounting firms. In addition, there are even several provisions of the Act that also apply to privately held companies, such as willful destruction of evidence to impede a federal investigation. The Act covers issues such as auditor independence, corporate governance, internal control assessments, and enhanced financial controls. A very significant part of SOX is also the monetary and even criminal penalties the Act imposes. Some of the Act's opponents state that the cost of complying with SOX is unnecessarily high and puts U.S. companies at a disadvantage. However, SOX has also been praised by a very large cross-section of the financial industry experts, citing improved investor confidence and more accurate, reliable financial statements. The CEO and CFO are now required to unequivocally take ownership for their financial statements under Section 302, which was not the case prior to SOX. Further, auditors' conflicts of interest have been addressed by prohibiting auditors from also having lucrative consulting agreements with the firms they audit under Section 201. As the next step, let's look at some of the SOX sections that are most important to accountants. There are several sections of Sarbanes-Oxley that apply to corporate governance and are most important to accountants. Section 301 requires publicly traded companies to establish procedures for accepting employee complaints, both anonymously and non-anonymously, concerning questionable accounting or auditing matters. This section also requires independent audit committees to oversee the procedures for receiving and handling confidential whistleblower reports. Section 302 requires that principal executive and financial officers certify that they've reviewed the findings of annual or quarterly reports and find the statements within to be accurate and free of any material errors. Those officers, normally the CEO and CFO, must also certify that they understand their responsibility for creating and monitoring internal controls within their organization and have evaluated the effectiveness of those controls within 90 days prior to the report being issued. That places really a lot of responsibility and accountability for financial statements on the CEO and CFO. Section 404 requires public companies to include their annual report in their annual reports a report of management on the company's internal controls over financial reporting. The internal control report must include a statement of management's responsibility for establishing and maintaining adequate internal controls over financial reporting for the company and management's assessment of the effectiveness of those controls. The external auditor must evaluate management's conclusions and issue its own report on the assessment of internal controls. What about Section 406? Section 406 outlines Code of Ethics requirements for senior financial officers. A code for financial officers comprises the standards necessary to promote honest and ethical conduct. Full, fair, accurate, timely, and understandable disclosure in periodic reports, and compliance with applicable governmental rules and regulations. Section 802 of the Sarbanes-Oxley Act imposes penalties of up to 20 years imprisonment for altering, destroying, mutilating, concealing, falsifying records, documents, or tangible objects with the intent to obstruct, impede, or influence a legal investigation. This section also imposes penalties of up to 10 years on any accountant, auditor, or other person who knowingly and willfully violates the requirements of maintenance of all audit or review papers for a period of 5 years. Let's now talk about Section 806. Sarbanes-Oxley encourages the disclosure of corporate fraud by protecting employees of publicly traded companies or their subsidiaries who report illegal activities. Section 806 of Sarbanes-Oxley authorizes the U.S. Department of Labor to protect whistleblower complaints against employers who retaliate and authorizes the Department of Justice to criminally charge those responsible for the retaliation. SOX also establishes the Public Company Accounting Oversight Board to oversee the audit of public companies, establish audit reporting standards and rules, and inspect, investigate, and enforce compliance on the part of the registered public accounting firms. Last but not least, Section 906 requires a written statement by the CEO and CFO that the periodic report containing the financial statements fully complies with certain provisions of the Securities Exchange Act of 1934, and that information contained in the periodic reports fairly present in all material respects the financial condition and results of operations of the issuer. Any individual who certifies any 906 statement knowing that the periodic reports accompanying the statement does not comply with all the 906 requirements is subject to a fine up to $1 million or may be imprisoned up to 10 years or both. In addition, for any person who willfully certifies such a statement, knowing that it does not comply, the penalties are even much higher, up to $5 million and or 20 years in prison.